There's been a lot of talk both ways in the market, but I think we see an inflection point, and we're going to discuss in detail what that means, why it's happening, and how to potentially profit from it for the rest of the year. We also get deep into retail prices, the weather, how things are impacting the consumer, which I think is fascinating and should be very interesting for the wider audience. So please listen on or skip ahead if you want to. There's no problem with that. We label everything on the chapters. As usual, we break things down by macro, pump perspective, we call it, for the retail, the winners, the losers, gold rush, widowmaker, all that kind of stuff. Check it out. Hope you enjoy. Okay, Martha.
So this week, Brent's been pretty flat. It's been trapped onto the 100-day moving average, and this has kind of had a knock-on effect across wider markets. And it's been pretty quiet and pretty range bound.
Yeah, no, for sure. I think there's no point actually talking too much about. It's just like a quiet week after the storm. So I guess straight into the nitty gritty, right, with the volatility. Let's break that down.
Yeah, of course. So just on my screen here, you can see the difference in the premium and open interest of the September's Brent futures this week, last week, and the week prior. And a month ago. And so you can see that the premium has increased for the premium has increased for the calls and it's decreased for the puts generally. We've seen that the
increase for the calls. Okay, so the call put skew's gone bid, as they say, right? The calls are getting more expensive. So
the lingo, sorry.
It's just generally speaking, that's the first signal of, I think, a lot of data that's coming through, not spoiler alert, but that people are starting to build onto a bullish narrative after being quite bearish for a while, right? And that's just the first indication. So as we've died down from the war, there's been a lingering kind of belief on the upside, essentially, is what the option prices are saying. Yeah,
exactly. And while the puts at 70 are way down, that's probably half. The premium there is probably halved in the week and down again from a month. So you can see they don't want that kind of out of the money put, which kind of makes sense. And then looking at the calls, the open interest at 95 is the highest, as we have seen the whole time, but that rate of increase has stayed fairly consistent. It's actually increased from a week to a week from the month from last week.
This is what, sorry?
That didn't make any sense. The premium for the 95 calls, that continues to be really popular.
Yeah. So what did we get this? We've spoken about it a few times, but it genuinely has driven the market to some extent, right? Three or so months ago, 2 months ago, maybe, all this interest in 95 calls, almost suspect type interest. Then we have the war go on, and then I think much more interest in 95 calls. And I don't know if that's just psychological for some people, because $100 per barrel seems to be so hard to break these days that 95 is maybe more realistic. But either way, I don't get the fascination, and it doesn't even look like much open interest is unwound, like you say.
No, well, interestingly, sorry, just on that, the premium for $100 and $105 is the same, and we've seen both of those prices, open interest, increase in the week. But although the premium for 95 has increased in the week and continues to, the open interest has dropped.
Interesting. So on the spike during the 12-day war, of course, there was a lot of interest, I guess, people piling in generally to insure themselves. But it was interesting that if the open interest hasn't decreased, and the big buyer, of which we know one particular fund was a huge buyer, doesn't look like they unraveled it. So
it's a very small decrease week on week.
Yeah, I guess you could argue, with a little bit more experience with it myself now, as in when you go into unwind a pretty decently sized option position, especially when it's gone your way, people don't want to, or market makers, which are usually banks banks and market makers are doing it in a bit more high frequency way. But the big banks, let's say, their role is to provide like a deeper liquidity rather than like a fast paced liquidity. So when they buy volatility off you, when you're long it and you're selling it back, they have to warehouse that volatility, right? So when they're buying volatility that high, it's like, well, I've got to believe that it's at least going to stay here or get even higher. And when it's so high, that's a very risky bet. So in other words, when you're trying to sell it, and at least in my experience, the banks are kind of like, well, no, I'm not interested. So if you want to offload a bunch of vol, I'm just not going to take it on. So you have to go and do it in bits and pieces with some of the market makers, more the higher frequency market makers, and find like more intelligent ways to exit it. So what you can do, and what I've seen traders do, and maybe what happened this time, is the 100 and 105 calls have been not depressed, but like haven't rallied alongside 95s, maybe because that's what they've used to profit take. So if you sell a bunch of higher calls rather than sell the call that you're actually in the position of, because you don't want to smash down the volatility, you don't want to smash down the value of the option by you doing that selling. Right. If no one's interested in taking it on and you start selling chunks, then you're going to get front ran, like everyone's going to pile into that and just basically mark to market smash your position. So you're better off selling a higher price call that's even less likely to get priced. And if you just ratchet it up, whatever, 120, even 200, some people buy, you just kind of sell down all those calls. You don't affect your core position and you get rid of the outright volatility that you're long. This is just obviously complete guesswork, but it's just seems like that's the story adding up. And again, in my experience, that's a better way of doing it. But the summary of what we've seen with volatility is definitely died down, but we're getting that skew back to, I guess we haven't got this definitively, but it looked like the skew was much more towards the put side before.
I can get a graph and put it in post.
Well, the fact that,
with a put call skew, the smile graph.
Yeah, what I'm saying is that last, let's just say the first 6 months of the year, it was much more to the downside. There was like deep producer hedging, as well as consumer hedging, but the general narrative was that prices are going to be lower. You've got like journalists, generally speaking, and supply and demand balances, generally speaking, say it's going to be bearish. And we've taken the view in the last couple of weeks, haven't we, that it's kind of, it doesn't look actually to be true and it looks to be going the other way. The only thing pointing to bearish prices now is like fictitious balances in the future. Everything right now, or the evidence we have in the next 3 months, is the opposite. And it feels like the market's starting to realize that. So even though we had the war and it's over, it's not really about that anymore. It's about like true kind of fundamentals, and where we're seeing things is just, that's fair, right?
Yeah, for sure. I think the market's view of balances has kind of tended towards the more bearish side, for sure. Morgan Stanley, a lot of the big banks are coming out with huge implied inventory builds, and it's true we have an implied inventory build in our balance too. But a lot of that is kind of eroded as you get towards the back of the forecast, and as things stand, the demand picture looks a lot better than we thought it was going to be 6 months ago. Especially in China, we're seeing a lot of stimulus pass through hit earlier than we thought was going to happen, and so in China as well, they've been taking a lot of that implied inventory build. So they've been building at about 1.7 million barrels a day. So in our balance, we have about a 1.8 million barrel per day average build this year. So a lot of that is just taken straight from China.
But that's the funny thing about a demand metric. So how do you quantify demand going forward? And the temptation is to be very strict with demand as a sense of GDP and economic stability. But when it comes to oil, it's actually kind of a little bit ambiguous, that, because especially with China, they are very sensitive to low prices, right? Yeah. So as you say, that they're building at an incredible rate, and their is it onshore or offshore storage is at the highest ever?
Yeah, onshore storage highest ever, but offshore is pretty big as well.
Right. And what that just points to, we don't think the China economy is booming. I know you're saying the demand is probably better than people are saying, but this would indicate in a model China thriving, right? But that's not, it doesn't matter what, it's just, are they buying or are they not? That's what demand really is. And they're buying because I guess the majority of the reason is storage, and the majority of that reason is because the price is low enough for whatever their economics are for natural resources. They seem to like it. So that's very hard to predict in a model.
Yeah, for sure.
And then we were having this conversation earlier on. So that's an implied demand of, great GDP growth, whatever. But still, going forward, now that that's effectively been priced in, can we still see this ongoing, basically?
Well, so the consensus is China are about 60-70% full on their inventories. So there is still quite a long way for them to go if they were to fill up.
Sorry, just quick maths. So it's like 1.1 billion, I think I saw.
1.127, something around there.
All storage or just onshore?
Onshore.
Okay, so roughly speaking, that's another 30%. So another 300 million barrels in theory could be added. I mean, that is quite a lot, to be fair.
So I think over 400 million barrels of additional capacity. So that would take them, over
another year if they were to do one and a half a year. Okay. Well, if they're going at the current rate, maybe 8 months, something like that.
And what they've also done is, even though they've had pretty heavy maintenance, so especially in Shandong, they've been running kind of utilization in the refineries at about 50%, dipping under actually in some months. They've still continued to import a huge amount, and that's just gone straight into storage. Once we see those refineries come back online, that could start to eat into that inventory build.
But just quickly, so that on our balances, let's say the incremental supply increase or over the excess is about what, 1 million barrels per day?
So this year it's about 1.8, and then it's down to 1.2 next year.
So it could easily be absorbed by Chinese buying.
Yeah.
So I mean that would genuinely explain quite a bit going forward, because I know we've jumped ahead from what our usual like process is for analyzing the market here, but I mean immediately all the signals, like the margins, the premiums, that there's literally nothing to say it's bearish apart from the consensus on balances. And when you've got that kind of dislocation, I guess there is this sense of what are we missing, right? Yeah. And I think I was always keen to point out that really the methodical way to do it, and we're all human and even I forget to do this really, is when you're forming a bearish picture and the market's been bullish for a time and you want to transition to bearish, you've got to see the signals first, right? Like the market was selling flat price and positioning short and deck Brent and things like that way too early on retrospect, because there was no actual evidence. You've got to see the margins compress and the oversupply filter through in some way. So the physical market signals would be a negative crude premium, i.e. like the current benchmark price is too expensive for what the demand is. So it's negative. People are buying below the benchmark. You have to see margins compress because the refiners are the main buyers of crude, and you're ultimately buying and selling crude when you trade flat price. And if that is still really high, then the refiners are just going to keep buying. Yeah. And I mean, so on and so on. You need to see product premiums. What are they doing? They've all been really strong. We've had an unbelievably strong bunker fuel market, but an unbelievably strong distillate market. Yeah. And then you're looking at the inventories, and distillate inventories are super low, and we'll get to all this. But like, it's really kind of caught me by surprise. I think other people by surprise, just how wrong the kind of market has been. So we'll go through it, but that's been reflected in the option prices at least, and I guess in people's trading, Martha. So volume and open interest.
So on the screen you can see the week-on-week changes for the respective tenors for the average daily traded volumes. So you can see Brent's has seen a really significant week-on-week change in all of the front three tenors, bearing in mind that Friday was the 4th of July, so there was trading on, like, not in America but in everywhere else.
So this is showing week-on-week changes for all of them. So to the day or the average?
The average daily traded volumes for the week to the 4th of July.
Okay. So it's pretty significant, right? When you say, so 40% down as a global total for every single day on average for a week. So, I mean, yeah, fine, there's a holiday in there, but well, yeah, you could say a lot. It shows you how much US trading there is. Yeah. But I think it also indicates, how much of a breath the market took right after that carnage, which again, it's hard. Generic observers of the oil market will always say, oh, what a great time it must have been for oil traders. And sometimes that's true. It just really depends on the volatility versus the conviction. So I think in this environment, I know in this environment, there was very low conviction. No one really wanted to be long. I mean, obviously there must have been a few people pre the crisis, but really it was a situation of people clamoring to cover their exposures, right? And that's why, again, we were so keen to emphasize that it was more of an options market than it was an outright market. So once that all dies down and people's positions came back in, if they were short or if they were long, they took profit, and if they were looking for insurance, they got out of it, and kind of everyone's okay was kind of how it feels. Then it makes sense that you down tools for a bit. Just go, it is July at the end of the day. It's go on holiday. I mean, that's pretty much what the market is essentially saying by those low volumes and low open interest. And on top of that, if you return to normal, I think we were expecting, the market was on a bull run up until the 12-day war. It overspikes, comes back, and it maybe almost overcorrected the other way. But, it's now people are remembering, actually, we are still in a kind of bullish trajectory on the underlying market. And there's not a huge amount of conviction for that, I think. So I just think it makes sense now, and it probably makes sense for the next few weeks, that there won't be like a huge amount of high conviction trading going on. I wouldn't have said. So it makes sense to me. Open interests low, volumes low, and but maybe skewed more towards the upside, which is essentially the summary. So in all, I would say a temperature gauge of what? Just really tame, right?
Yeah, pretty tepid.
Tepid, nice word. Okay. Now let's move to what's driving the market. This is the herd mentality. Okay, so I think let's just put the 12-day war behind us. And we said last week, attention should focus more on OPEC with the meeting coming up, and we had the meeting. So, I think rather than do the crossing to official section, we'll just basically point to you for this, because this is what it was all about. The OPEC side, this is kind of what you cover. So I guess what happened in the meeting versus the expectations and so on, OSPs and all that.
Yeah, so in the lead up to the meeting, there was a lot of market chatter about there being another 411,000 barrel paper unwind. I think it's broadly consensus now that the OPEC unwinds are more kind of bringing quotas up to production than increasing any production. But we actually got a bigger unwind than that 548,000 barrel per day for August. Importantly, this is still a paper unwind.
The full 548 is still a paper unwind.
Still a paper unwind. The one producer country that has the capacity to actually materially increase production is Saudi Arabia, and we did see them do that last month. But it's still up for debate whether that's actually them opening the taps. And then we got the Saudi OSPs on Sunday, which I think were the kind of they provided bits of clarity on Saudi's intentions. So that
in that they were higher.
Yes, so they were pretty big. So the Dubai structure between May and June trading is what typically people will go from in terms of their expectations for OSPs. So the change in the Dubai structure, and that had implied a hike of about 60 cents. And then Saudi Aramco came out and hiked by $1. So that's a pretty big upward surprise.
But you would only do it if you thought the demand was there, right?
Yeah, exactly. If you thought the demand was there, also to give a signal as to we're still being conservative. We are holding back production. That's why we can't hike by that much more. And that's consistent with the month prior as well. That had implied a 40 cents cut, and we only got a 20 cents cut. So they are starting to shift a little bit more conservative than Dubai structure would imply. There's also the Murban situation last month, which will potentially have seen some buyers decide to lift
Saudi over ADNOC.
I know if I was going to be lifting that, I'd want to make sure I'm getting the full 500 nomination allocated. And I think some people are concerned now that with ADNOC, you can't guarantee that.
Yeah, I think it's worth going back over that again. I know we spoke about it last week, but yeah, it's in this case, it's not always the seller's option. Sometimes it's the buyer's option when it goes to buying and selling crude. You can basically adjust the amount agreed upon. So if it's 500,000 barrels per day, typically what you see is a 1% difference in the tolerance. So you could say, actually, I'm only going to do 494, or I'm going to get 506. This was 20% or 30%, something 40% difference. So it's basically just a complete mug off, right? It's just like, I know I said I was going to give you 500, but I'm actually going to give you 200 or whatever it is, 300, which was really, really screwed people. And if they hedge on the basis of 500, so you booking 500, but it's for loading in 2 months. So you've got to hedge for that 2 months. They sell the flat price roofs. They massively lose on the 500 kb hedge. They expect to make it back on the physical that they've bought, but it turns out the physical they bought is like 40% less. So they basically just lost on 40% of their hedge, which is it's devastating. That's many millions, and it loses trust. And then there was a bit of denial, and then it's like never happened. And then I think Reuters reported it. I think Platts reported it. Bit late, but whatever, like it just didn't make huge news, which all had this kind of sense of like hush who did it, whatever. It was clearly a big impulsive angry decision, which you get with OPEC, right? They get very emotional, and they say these like random like spurts of anger in the market, and the journalists, and they make moves like this. but they know they're OPEC, right?
Yeah.
At the end of the day. So who's going to stop buying Abu Dhabi crude at the end of the day? Who's going to stop buying Aramco crude? So I think that'll be forgotten pretty soon, to be honest, but I hear what you're saying. And then the Aramco thing, what I would add to that is when they get so confident on demand, I know that there was a reference to refinery margins and a reference to physical diffs being strong. Okay, great. But realistically, I think it's going to be more their buyers. And who are the main buyer that would signal to them a degree of confidence that is not the free market? And that's China, right? They'll say, look, I am here to buy a shite ton of crude. Yeah. And you don't really know what's going on behind the scenes. They could have committed to saying, all your excess unwind will take as storage. They might have agreed that. They might have already agreed to a 1.5 million barrels per day extra buying and Saudi therefore know that everything that they overproduce now is going to get absorbed and they're bullish. So by them saying we're overproducing and we're raising the OSPs, you're going, you must be pretty damn confident you're going to clear that. And if you look at the statistics in the market, it actually backs up what they're saying. It's getting absorbed somewhere. If you're Javier Blas and you're saying things like the market is clearly oversupplied, you know, you're not a trader. You're clearly not looking at things and how things are priced in, what's really going on. You're looking at some generic analysis from like JP Morgan or whatever, and you're saying OPEC are producing more, like it's obviously going to go down. But you've got to ask why, right? And every time that they've overproduced in the past, they undercut. And that's why the OSPs were so important. Official selling prices, that's why we keep going on about premiums all the time. Again, for viewers who are not as, fluent in this language, we go on about premiums and discounts because all you can go off is the benchmark price that the collective industry, has a lot of visibility on, which is Brent or whatever the benchmark is, but ultimately always comes back mostly to Brent and WTI. So that's where the flat price, that's where the accumulation of trading positions, they've all been brought together to say this is now the day's price. Is that under or overvalued? Well, that's now a physical market thing. If the physical market thinks it's overvalued, it will just mean buyers are less willing to pay that price. So the premiums will be lower or the discounts will be lower. So when they come out and say that the premiums are high, it's like a very big statement. And we've seen Jorge and you guys as journalists yourselves have been told by Chinese consumers, they're all angry and pissed off. But why would you be angry and pissed off? Because you want the crude. You see what I mean? So you're being forced to buy at a high level. So all the indications are that the market's getting this wrong. The Saudis, as always, have the maximum visibility over the market. And they're pretty damn confident. So I imagine they're pretty bullish. And remember Putin not so long ago was saying, I agree with their assessment. He must also be seeing a lot of term buying for his oil and all that, right?
Yeah, definitely. I mean, there's definitely a big appetite for Urals and Espo at the moment in Asia. But yeah, I completely agree with what you're saying. I think we're hearing as well that nominations are going to be pretty big out to Chinese refiners, and we'll get those in the next few days. So stay tuned to hear about that.
It's an inflection point for sure, right? And I guess I'm still confused because 104, 105 million barrels per day we're up to now as that's what the world needs to satisfy its demand. It's huge. It really feels huge because we were meant to be plateauing. We were meant to be having loads of non-OPEC supply, but it does feel like as soon as you say the only ones who can overproduce are Saudis and the amount they can overproduce by is probably like another 800,000 barrels, maybe 1 million. That's not that much crude on the scale of things, especially if China are there to pick it up, as we've been saying. So it's looking, I don't know, man. It's definitely an inflection point. I never thought I'd be sitting here saying it this year. We could be on a bull run like that. It's actually sustainable, but it does look to be heading that way, unless we get past the summer and I don't know, we just get a massive drop off demand, which in Q4 does tend to happen. But I repeat, you have to look at the refinery margins signals first and the crude premiums first. And the only thing I could say to counter this argument right now is that we've seen an incredible amount of refinery margin hedging in the East, funnily enough, not so much in Europe. And that refinery margin is really like focusing on the distillate part. And I think there was a consensus, at least among us and among the trading community. Distillate had a big rally, like $7-8 per barrel rally on the crack, on the difference between crude, which is a big rally. And there's reasons for that, low inventories, fundamentally, all that kind of stuff. But really, we felt it was people stopping out of short positions because of the war situation. And there was huge, long gasoline versus heating oil positions that when you unwind that is more bullish impetus to distillates. So that is now $21, $22 per barrel, which is a very healthy distillate market. And the refiners are just attacking that part. They're selling all the way down the rest of 2025. You know, we're talking like 3 million barrels per day from a couple of refiners. You know, that's huge, and there's more obviously getting involved. So that doesn't mean it's bearish. It just means that it's good value for them, and it means they're going to be producing a lot. But if it holds up, it means that the market can take it. Yeah. And that's the last kind of signal, is this refinery margin. We have seen the fuel oil market starting to like get a little bit shaky and weaken. But you know, if the other cracks are big enough, it doesn't really matter. But I guess from a herd mentality perspective, it's like you said, like the consensus seems to be forming that the people are aware that these OPEC production releases are not that big a deal.
And there is still, you know, the other two tranches of the OPEC cuts. So you have another 1.66 million barrel per day of voluntary cuts to get through after this 2.2 is chopped off.
But you're saying that can only really be unwound by Saudis.
Yeah. Because of the overproduction. So we aren't quite up to, on a quota basis, up to production yet. It's still
okay. Yeah. But anyway, we think the market kind of has a sense of that. And you would take that because of the signal on the open on Sunday night. You know, you have an over the weekend OPEC meeting where they're bringing a lot of supply back on paper, whatever. The market barely blinked. Yeah. Like 50 cents down, and then what, $2 higher?
Exactly.
Or $1.50 higher? That's a big signal from the market that we don't give a shit about these production increases anymore. We actually think this is either quite bullish or not bearish. So, you know, journalists, Javier Blas, whatever, these banks, like, just ignore them, right? Because it's like the market will tell you how they feel, and the market will give you the physical signals as well that this is pretty bullish. So we need to kind of hunt for the next signals to get clarity for the rest of the year. So what does the market now look at now that the OPEC meeting is gone and we've had the OSPs and they're really strong? That's a signal that we're strong. But I mean, are we looking at like the hurricane season now, the weather, or?
Yeah, I think when we talk about refineries in a minute, I'll touch on the weather, because that's been really interesting, especially like the lack of, hurricanes, but also the impact that the hurricane season is having on wider weather events. So obviously the flooding in Texas has been a huge disaster, and kind of we're seeing an increase, for whatever reason, in these extreme weather events kind of across the world. And I think getting to grips with the changes that need to be made in refineries and the changes in output and optimization is really important. So I'll get to that in a second. But firstly, just to what the market's looking at now, we did have a look at the macro kind of decoupling that we've seen. So on my screen now, we can see the dollar index versus the Brent, and also the S&P 500 versus Brent. And this is a correlation. So we can see the correlation between the dollar and Brent has gone up to around 40%, which is really unusual. And kind of when you're taught about the markets, when you first join, you're taught, like, as a general rule, they're, inversely correlated. And then,
sorry, this is the US dollar as like an index.
Yep.
So the dollar index versus just Irish Brent. Okay. Mm-hmm. Has done what?
The correlation between the two has increased to 40% of
proportional. So it actually goes up with
positive correlation.
Positive correlation. It's always been negatively correlated, allegedly, but as it's not really at all, right? It's maybe in extreme scenarios, but
So that's interesting, and we can see that that's kind of the opposite of what we're, quote unquote, taught. And then on the right, we can see the correlation between the S&P 500 and Brent. That's become far less correlated. That's dropped to almost minus 40. So the correlation between those two things has kind of collapsed, and we're not seeing those move in tandem as we saw them kind of lose negative correlation in a month or two ago, and that's crashed again.
So what does that indicate to you guys?
So I think there's been some kind of pretty idiosyncratic capital flows from the US in the...
All right, nerd.
Some atypical capital flows ever since the Trump tariff Liberation Day. We've seen pretty huge outflows despite a pretty strong recovery in the S&P 500. Typically, when you'd have a strong equity market, you see portfolios shedding their bond positions, which would see treasury yields improve, which should see a strengthening in the dollar. But we haven't seen that. people have been buying a lot of German bunds instead as their safe haven. So we've seen a lot of strength in euro dollar.
Which is amazing, right? Because Europe's meant to be the death place, everyone's dying. And
Yeah, well, they've had the German fiscal, everyone's getting the new fiscal package coming in Germany.
Interesting.
And
this is despite the whole big, beautiful bill thing.
Exactly. I mean, the big, beautiful bill, again, is a worry from a fiscal sustainability perspective. So that's what's been driving a lot of that kind of more deferred treasury selling, has been kind of concerns over the fiscal situation in the US. Chinese government bonds, the credit default swaps for an equal maturity were lower than that on a treasury.
But CDS, the value goes higher when it's more risky.
Exactly. So
and China's lower than...
China was lower than the treasury for a while. So
nice.
So
yeah, and I guess, okay, look, this is super interesting, but generally speaking, it's just worrying. Like the US economy is essentially worrying, and it's kind of the pin-up thing for economic health. And but then the correlation with oil, how does that link then?
As in, so for it's basically, what does this mean for oil demand? And obviously, the weaker the dollar, that's gonna help foreign importers because their currency is appreciating relative to the dollar, and that's going to be constructive.
So in a way, the rest of the world who consumes oil wants the dollar to be weak, and the prices to be weak because they get double whammy. So they want a bad US economy, but oversupplied oil, and that's kind of what they're getting.
And it kind of adds to that bullish narrative.
Well, from this price, again, it's always what we're talking about is bullish and bearishness from a price. And we've obviously, with the price sensitivity from China clearly, and consumers at the beginning of the year as well, clearly in the 60s, there's a lot of demand. And that's essentially what we're saying. So bullishness from here. But anyway, this like in-depth macro analysis is done on Macro Mondays every week. And I think you must have talked about this yesterday quite a bit, right?
Yeah, so we did a section on Eurodollar. Eurodollar's 50% of the DXY. So that's contributing a lot.
Well, I recommend people go and check that out, because clearly there is a macro shift in sentiment, right? Ultimately, even saying that people are excited about the German like bond market, that kind of thing. Yeah. I do notice like a very, generic shift in mentality that Europe and Britain have been smashed for so long. And it's not like that's changing, but their currencies are improving. As you say, the safe haven investments seems to kind of be heading that way, more private equity investments, things like that. So maybe we've reached that kind of rock bottom time. I don't know, but it's worth kind of bringing that into the forefront now, because as you say, Martha, like in the absence of other things, what are we going to look at now?
Yeah.
So the macro situation and the tariffs, I guess, are back in the menu.
Yeah, definitely. So just looking at some not tweets, truth socials that Trump's done over the past week, he's introducing anyone aligning themselves with BRICS gets an extra 10%. He's kind of throwing those around. And then as of yesterday, before he did the extra, 4 or 5 yesterday tariffs, they had only reached 2 tariff deals and a partial deal with China. And they've extended the deadline to the 1st of August. And then yesterday we saw deals with South Africa, Myanmar, Japan, Korea. Yeah. So there are deals being made, but they're running out of time. And we were discussing kind of why are they making them now? Have they reached an impasse? Do they feel like who's winning and who's losing? But I think at the end of the day, there's only so many hours in the day, and they have to get them done by the 1st of August. And they have to start
following the narrative that the market's starting to say the world economy is okay, but the US are not as okay because they're messing around with all this fiscal policy and tariffs. And actually that just means sell US buy everywhere else. It doesn't mean the net economy goes down. So it's not necessarily bearish oil, because people were using tariffs as a proxy. Well, the more tariffs were extreme, the more bearish oil markets were. But I can't see that now. I can see it as it's just bearish US.
I think all of this just speaks to uncertainty, which I think is kind of linked to what we were saying about the movement between what has always historically been safe assets and not. I don't have a macro background, but for me, that's what is clear, that we've been taught something is how the market works, and now we're seeing it kind of break apart because there is no certainty. And I think this tariff news is really playing on that, and that also links to kind of the macro headlines we've got coming up as well.
Okay, so it's kind of not that clear basically what people are looking at going forward, and that's okay. I mean, again, it speaks to volumes therefore being lower, open interest therefore being lower. So in a way, they're hunting for the next narrative, I think is kind of how we conclude it. Okay, so now this is the section for Macro Mayhem. So I think we've just spoken about macro, but it's okay. I think that's kind of the generic backdrop of what's maybe filtering its way into oil. But I guess just spending a little bit more time, I guess, from the fund side, the hedge fund side, in particular, what's going on the macro side?
There's just been some quant hedge funds headlines really saying how successful they've been in the volatility and the uncertainty, which kind of links to what we've been saying. This first one's from Bloomberg with some first half returns for a bunch of quantity funds there we'll put on the screen. And then the second one's from Reuters saying the same thing, good half year returns. We've seen trend following quant struggle, losing some to their worst years, whereas the quant funds that like excel on volatility, they've done far better.
Yeah, that's really good to hear in a way, because we wanted that confirmation, because we've been talking about CTAs obviously every week. It's a key staple of the analysis in the market now, and we were debating whether they're making money, right? Because of the volatility is too fast for them. They want like a low volatility, high trend. That's really their optimum scenario. And we were just basically saying that clearly isn't good conditions for them. They've clearly lost money in oil, but we don't know whether the trends have maybe been better in other asset classes, other benchmarks. I think what you're saying, like all-time lows potentially, would make a lot of sense, because the market's been so volatile. But again, no one's going to have just CTA in their portfolio, right? That's just one thing to profit if it's trending. And I guess if you've got like a risk parity portfolio, you'd be going like low weight CTAs, or increasingly lower weight CTAs on what you're investing in, and more higher weight volatility type funds, I guess, right? So
so the Reuters article reported systematic hedge funds down 60.68% in June, but they're still up 12% year on year in 2025. But there's still some funds doing really well, like Bridgewater.
Systematic is such a generic word.
Yeah, I guess.
But CTAs, we think...
It's nice to put a number to it. CTAs, I think it depends. Yeah, CTA in the trend following swinging way that we look at it have struggled.
Yeah, that makes sense. Okay.
And just to go with that, I can show our CTA positioning. So in a way that we're looking for what's going to be driving the market, there is little clues to be taken from CTA net positioning, as it is essentially completely flat. So we can see huge swings in either direction from here.
Which again makes sense.
Yeah. Really little to say here. But we've seen some products rise into the positives, but I think it's important to look at it as a total of the, main energy futures, and that's flat.
Just a great summary of the whole market. It's been whipsawed out of positions, and now we're flat. And let's look for the next narrative and start again. So that's kind of got to be the theme, right? Now let's move more to the refinery margins, given their importance as well. This is the crack spread Chronicles. So yeah, we have to focus on this, because this is again such a key part, and has been such a key part this year. I think I was definitely guilty of leaning towards margins being overcooked and ready to compress violently, which can always happen, right? They can move very swiftly into a potentially even negative environment if the oversupply has been kind of propped up. Sorry, the margins have been propped up in a period of oversupply. It can happen, and then you get that kind of compression a lot of the time in Q4, because you come out of the peak in Q3. So to be clear, there's still a decent probability that could happen. But I think every week that goes on, we're going to look for those signals. But as it stands right now, I would generically say that's a wrong narrative. It's a very healthy refinery margin, and sustainably so. And I would justify that in summary because the refinery margin hedging is getting absorbed. Any time a refinery can just throw volume at the market relentlessly at a high price, and it sustains that volume, then that by definition, the market can take it. Yes, eventually when it comes to the prompt and it comes to actual physical delivery of all that oil, which becomes agnostic to the price because they've already hedged it, then we'll start to see, can the premiums handle it and all that. But that's now going to have to be a while away, because it's all been hedged and whatever else. But what have we got to say?
Yeah, so just on the screen, this is the M1 Euro margin. As you just said, it's so high. I mean, disregarding the highs of earlier this year, we're looking at kind of highs of February in the year prior. But these are really high levels, and they're, as you're saying, being sustained well.
Right?
Yes, crazy.
Yeah, if you see the dip, we got a dip during I guess that would have been peak crisis. So maybe post the crisis, even a little bit of profit taking for refiners, or at least hedging or whatever, or people who were long profit taking. But no, it all just bounced right back up. And there's nothing that you can't really add any geopolitical stance to that, because it's all been and gone. The volatility is low, the conviction is low. It's just stable, and it's in the period of homeostasis at very high levels. That's bullish. Anything else we can really say about that?
No, and then after this, I just kind of looked at kind of a demand picture for Europe in particular, looking at the weather as we enter summer now. We had a...
Sorry, that is good. Maybe we did say in the herd mentality that the weather should be something people should focus on.
Yes.
It has always caused shockwaves in recent past. So yeah, let's definitely
this is focusing on Europe as like hurricane season is, as I said, in effect in the States, but you wouldn't know it. There have been 2 typhoons happening in the Pacific, but one is kind of dissipated to be a tropical storm over China, and the other got taken down from typhoon status over Taiwan. So we're not seeing that kind of impact on the markets yet. I think. But
we do. It's more like August, September, no?
Yeah, but we had a couple this time last year, named storms. But I think, by the grace of God, we'll have fewer this year. But I think,
isn't it meant to be the highest hurricane season?
In my opinion, no. But some people have said it should be around the same as last year, which was very active.
Okay, fair enough.
But fewer, stronger ones, I think.
So we don't want to ignore it, but at the same time.
Yeah, so the thing that's preventing like significant Atlantic hurricanes right now is there's dust coming over from the Sahara, which stops good amounts of moisture being absorbed into the air. So we can kind of monitor that situation, and you can keep an eye on that online to see kind of how much that Sahara weather is still impacting the Atlantic, and how much kind of what the conditions are like for hurricanes. But yeah, these kind of extreme weather events are due to the warmer air being able to absorb more moisture, and then you can see these flash floods. I think will continue to be a theme, but that's kind of a separate point. So looking to Europe, we've had this like crazy heat wave, and that kind of got me to think about what kind of the impact that's going to have on not only demand but supply from refineries. So we're looking at increasing temperatures every year as a general rule. Europe's getting hotter, especially Central Europe. It's been really, really hot. So basically the designed operating range for European refineries is generally maximum 35, 36 degrees. So past this, we have to look at what kind of is going to be impacted. So this is kind of the main effects of a heat wave that I think is important to keep an eye on in terms of refineries and also electricity. Electricity kind of from nuclear power, which affects natural gas and coal as well. So is always important to be looking at that too. So just in terms of getting data as to like, does this actually affect refineries? Yeah, of course. We hear not only headlines of increased fires or like increased flaring in refineries when it's very hot, but also in 2023, med refineries were forced to cut almost a third in the second half of 2023, which sounds really, really high. That's from the Bank of America. Wow. Yeah. And also, if there's an extreme heat wave, which as a general rule is over 35 degrees, you can see a 15% cut in the throughput of a refinery. So it is really important to keep an eye on these things. And I think something that it is important to know what actually affects them, because some of the things I was like, well, thermodynamically, this should do this, but that's not actually really how it works. I spoke to James Anderson just about this primary thing we have on the screen here of the cooling capacity of the CDU. So think of the distillation unit, and we can, in hotter temperatures, there's less effective cooling because there is basically air transfer cooling with like the air. So that's less effective. So you're seeing like more light ends heavy coming out, more light ends heavy flow coming out, and it's harder to get the longer chains condensed. So that would have a small impact, you would think. And then also having the kind of naphthenic crude that we already have with Midland, distillates being run in refineries, it'll be interesting to see how much of a problem this really is, and how much kind of overproduction and de-optimization of kind of refineries that we're going to see with this really light end heavy crude, and also a light end heavy bias in the low cooling capacity in the towers.
So generally speaking, European refiners are geared towards more lighter crudes, and that's from the US, the WTI Midland, it's from the North Sea. And but you're saying that like a very hot environment speaks to more heavy, you should be running more heavy crudes, is what you're saying, right?
I think, yeah. So, yeah.
And in extreme weather environments, that's what they should be doing, but they're not geared towards doing it. So the more likely scenario is heat waves basically cause, as they did in 2023, massively reduced refinery capacity, which is exactly what Europe doesn't need, because it's reducing its refinery exposure as a continent. Downing, closing refiners, generally speaking, selling them off, repurposing them to LNG terminals, whatever they're doing, which means they rely a lot on imports. And that could really go a long way to explaining, and I think you actually mentioned that the distillate rally could be a big part of that in Europe, right? If it's not able to produce gas oil as a general thing, it's historically not being geared towards running crudes to create distillates, to create gas oil, then it needs to import them. And then on top of that, what you were producing is being less produced because of the weather environment. Like, it just speaks to a big distillate, lack of distillate, basically. So that definitely adds to the narrative. And on top of that, like, the power and gas guys, Wernie and Zoo, were saying that what's been driving the power market is a few different things. And it was very low wind for the first half of the year. Suddenly the wind's back. So you expect all the renewable infrastructure to be generating more power and lower power prices off the back of it. But now we've had heat waves that the rivers are getting so hot around, particularly in France, that are used to cool the nuclear power plants, but they're too hot. So they've had to decrease the operation of the nuclear power plants, decreases the power output.
I think it's more that there's such strict restrictions on their water coming out of the power plants that when they have heated it up too much, they can't, especially in Switzerland and France, where we had the instance last week at the beginning of the month. The EDF had to shut the reactor 1 at their Goldfresh power plant on the 29th of June due to an anticipation that the Garonne River downstream would hit 28 degrees. So there are such strict rules about kind of the biosphere and what temperature the river can and can't be, that they just have to kind of turn it off and wait.
So it just speaks to higher energy prices, unfortunately for the European audience.
So this is quite a good graph to show that. So this looks at the French daily power generation versus the French temperature of a specific river, the Rhone. And you can see right here in the summer of 2022.
Sorry, the red is the temperature.
The red is the temperature, yeah.
And the blue is the output from
the nuclear.
And it's obviously just inversely correlated.
Yeah, so that's just a good graph, I thought.
No, to really emphasize. But what I'm saying is, Europe is fucked when it comes to energy anyway. And on top of that, it's just not built for high temperatures. And there's been some funny discussion online, like social media, particularly with Americans laughing at us, being like, oh, the heat waves, man. They're like 28 degrees. That's like, for us, that's like a cool day. And there's all these jokes about it. But the reality is, even Americans in England are going, no, seriously, Britain and Europe is not built for high temperatures. So there's like barely any air conditioning. Like when you're actually out and about and you're in the Victorian homes that we have and all that, you're getting cooked. And it's horrible.
Victoria Line,
yeah, exactly. All the tubes and all that kind of stuff. But it's deeper than that, because our infrastructure for producing energy cannot handle high high weather temperatures. And so it's not good, right? I mean, we're going to be struggling for this for a long time. And then on top of that, reducing our capacity, not improving it and not increasing it, it's just playing into this narrative. It's going to continue the narrative of I don't know how to say it, like the energy prices keep getting higher, there's no way around it, prices keep going, and what's the possible solution to this? Because if people are right, generally the consensus is right, we're going to keep getting hotter and we're not prepared for it. So not good. But what else can you say other than for this looking forward, if there is continued continued hot weather, that will be bullish product prices, so like diesel and gasoline,
in particular gasoline
and fuel oil, right? We keep talking about fuel oil, the lower part of the barrel being typically negative, bought by bunkers to fuel their ships. It's also used for power generation, and as wind is choppy and basically non-existent for a lot of this year, you have to go and find more reliable sources. But if you can't use nuclear because of the hot temperatures, you are left to burning a lot of this fuel oil, not even crude oil, fuel oil, which is really dirty, mucky stuff. And it's what the Middle Eastern, they love to use, right, when in the hottest temperatures. And so that's always factored into the market air conditioning demand. But I think actually probably less of a consensus is that that's probably going to be used more and more in Europe because of the mess we're in, basically.
We're forecasting a 33% increase year on year in LNG demand in Europe in the summer. I think that's
LNG, that's the thing, LNG, like, it's fine to say LNG, and we've built more terminals as a continent to import more, but we're also very vulnerable because if we had adhered to the storage targets that were set in place in the EU, you say we, like the EU, then they would have basically there wouldn't have been enough LNG, and it would have created a very tight gas market again and huge prices again. They kind of relaxed them, so it's okay. But what I'm saying is, what this points more to is looking for alternatives, of which oil is an
coal
even, exactly. So those people who don't want us to use fossil fuels, it's going the completely other way. I mean, that's all you can say.
Especially in Germany, shutting down a lot of their coal infrastructure. Also, now Europe are kind of cut off from Russian gas. They're turning a lot to renewables, which have been pretty catastrophic, as we saw in the case of Spain recently. Add on top of that a pretty sensitive grid infrastructure. I mean, it's the same in America. We had a similar power crisis on the other side of the spectrum with the Texas freeze, when their grid went down, and we saw spot power prices in ERCOT roof about 8,000%.
Their grid is, that's the special Texas thing though. Their grid isn't connected to the wider country.
Yeah, it's an ISO in Texas. But yeah, Europe as well is exceptionally vulnerable at the moment
it's hard to see
like this.
And people love to say nuclear power is kind of the answer to every question when you talk about this like wider issue, but people don't realize that there is kind of so many rules, especially in the EU, about biodiversity and kind of having that outstream. It's a vital part of the process of the heating and cooling. That's all essentially you're doing. So yeah, definitely something to keep an eye on in terms of kind of engineering in the future as well.
But I think it's generally the weaker the infrastructure is, the more bullish the outlook is for fossil fuels, in my opinion. And on that doom and gloom note, I think we should talk now about the pump perspective. This is the section where we're trying to get more towards the consumer, the end user, and the prices that impact them. A lot of what we talk about, if not most of what we talk about, is the wholesale energy market, oil market in particular, and more so the energy market. We'll get there. But let's talk about the actual, let's just do the UK. Obviously, we're in the UK. We've talked more and more about building a live price for gasoline and diesel in the UK, so people can kind of have more relation to what's going on in the wholesale and how it impacts them. So let's go through what we've done lately.
So if we look on this chart here on the Onyx Markets website, we can see our weekly UK diesel pump prices since the 1st of January. We can see they've started to sort of rally a little bit, and obviously with barges in Europe being really strong and distillates in Europe being quite tight, we might expect that rally to extend a bit further.
So this is the prompt live, this is the price that you're actually getting at the pump.
Exactly. So that's inclusive. Obviously, you take your barges, your Balmo diesel contracts.
So those are all the wholesale contracts, right?
Yep.
So remember, So now you're saying, those have been rallying in the last, we've kind of been talking about a more bullish than bearish market forming, and even before the 12-day war, we were rising in prices. So that will explain that, basically the uptick that we've seen in the last, how long has it been in that? Like a month, basically. And I guess we're going to expect them to continue. That's what you're saying.
Yeah, I mean, so to get the kind of price of the pump, you need to obviously include the renewable transport fuel obligation, which is a HVO requirement. And also then you add in your VAT, and then there's a bit of a supplier retailer margin as well at the forecourt, which you include there and estimate. So this is our estimation of what prices at the pump are, and you can then see the forward curve here and how that has.
Yeah, so this is another thing, right? So when we say the forward curve, like right now you can trade contracts into the future for the wholesale prices. So that's all that the world's, integrated oil prices and all the products. So relating that back to the UK pump prices, you can get a very strong idea of what the prices will be if you suddenly freeze in time and say, right, the forward curve and all the prices into the future from a financial perspective. If you're to freeze that right now and nothing changes, then we can see if the price in August or September or October will either go up or go down. And we can see, generally speaking, that we're going to be continuing to increase in July, right? But if we were to just freeze it, things will slowly start to come off, is kind of what we're saying, right?
Yeah.
But the reality is you've also got to factor in prices are going to move into that period. So if you are bullish the entire oil market which is kind of what we're talking towards, then you've got to expect these prices to increase. So what do you do about it? Well, right now you can go on Onyx Markets, and actually it's not available today, but it'll be available very soon, where you can go and buy in August or Sep or October or November contracts, and you literally the UK pump price, where it's pricing right now, and buy it right now. So if it goes up, you've got protection financially. So when you go to the pump and it's actually higher, if that's the case, you'll have at least a protection, you'll have some money back essentially. But I know this is like way too complicated just to chuck on people and expect them to be like really fluent with it. We are working on a product that will be much more intuitive and much more linked to how you protect your prices. And that's going to be a few months at least, but this is to give a flavor for it. But I guess the general point is, this is why the energy market, the financial oil market and energy market is so useful, right? It gives you like certainty into the future if you can interact with it. And it's essentially an insurance market if you can kind of get the word out and get people to explain that. And we had, not a viral video, but decently, what was it, like 150,000 views on TikTok when we were talking about how prices were going to rise for the UK pump prices. And clearly people were very angry, right? They were like, well, for fuck's sake, is this like yet again type thing? And there's a lot of things to blame, but ultimately if you just look at the movement of the price, that's correlated to the movement of oil prices around the world. So these things are not that predictable, but you can at least understand what's going on and have more of an understanding, a war in the Middle East and how that's impacting the market right now, and therefore how it's likely to impact your pump price in the next coming weeks, because there is a lag. These kind of things, the more you learn about this market, the more you can relate it to your market. But the UK in particular, like Will just said, is that unfortunately you've got to add in more variables, which are taxes, duties, like renewable prices, and they're also very high and getting higher because of the lack of infrastructure and sustainable infrastructure we have for the hot weather. So ultimately, that's just going to add to that retail price, and we'll start to see that more. But some of these comments, you said they were mugging me off, and you wanted to go on.
More mugging off what we do as a profession, just saying that it's just controlled by greedy politicians and oil-rich companies, and then it's just people
That is true though. So as in, that's not us, right? That's the oil world is, absolutely. So what I find fascinating about this is there's a lot of people say, oil markets, they're kind of on the periphery and who cares? Like, clearly people care, right?
100%. So, people are pissed off.
Exactly. So give us some juice.
Well, apparently fuel tax going up.
Fake as the chickens that's coming out.
I don't know what that swear word that's meant to be, or else I would have read it.
Okay.
And basically the gist of everything is saying that prices at the pump go up when the prices go up, but then their rate of falling is much slower.
This is quite interesting. This guy's saying, go back. Petrol details hike their prices instantly at the nearest whiff of global oil price rises. Blah, 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 but then a tiny fraction of when they go down. That's absolutely correct. But there is a correlation, right? They can hike the premium on top of the calculation. So we can definitely break this down. In fact, I think we do break down when you look at the retail pump price, a certain percentage, let's call it roughly 30%, is the actual global price for gasoline. Not the global price, the European price, which is impacted by global markets. Why don't you get that up then? So, as you can see, like the actual base fuel that we've called it here is around a third of the, or 30% of the overall price. Then you have, could you just, Then you have the, 12p, which is the retail margin. So that's what they're talking about, these supermarkets, etc., moving around. Yes, they can increase it, but ultimately that's the margin they're playing with. They can't actually increase the base fuel, right? That's going to move up and down based on the global prices. But I see the point. And then, to emphasize, VAT and fuel duty is like half the price. So that's fixed. So it's just good to get more visibility over this stuff.
Also, the interesting thing, obviously, these forecourts, they have pretty much a regional monopoly. So if you're on the motorway or something and you need to refuel,
or in Norfolk.
They have almost price setting power. So from that means that their margin can extend on the way down, even if it won't compress on the way up, which means that you have a rapid acceleration in the price on a rally. But as prices normalize again, the price of the pump might fall a little bit more gradually, which I think is what we're getting at.
Yeah, that's what we're getting at. But ultimately, in the long, what I would desperate to communicate more with tools that we come out with that people can actually interact with, is that you can protect yourself against price increases. But when you protect yourself to some degree, obviously you have to accept that it might go down even, you might get more savings. And if you fixed your price ahead of time using the financial market, then that's it, you fixed it. So if it goes down, you lose money on the hedge, but you have a saving on the physical, and vice versa. So it's how you really play. So what we're going to be looking at doing is more, options around this stuff, and we'll get there. But it's just the general point is there's a lot more to understand about this market. There's a lot more visibility to be gained about what's going on. So when someone says it's all driven by greedy politicians and oil markets, absolutely, right? But the thing is that you can at least get visibility over that, and you can at least learn what they're doing and the games that they're playing. And this is what we're talking about all the time. We are breaking down the different players, and the only good part to it is that there's greed both ways as well, right? Like, so oil politicians want lower prices in the US. Sorry, politicians in the US generally want lower prices, like Trump, because it helps his political standing. So there's a lot of pressure from him in certain areas and making deals like the arms deals and things like that to get prices lower, combated by obviously producers who might even start wars for all we know and do dodgy things to get the price higher. Like, this is all part of the global game, if you like. So it's and then don't forget the speculators, right? And forget the industry, who are many times the volume of the physical. So therefore the impact of their trading is actually more impactful on the price that we consume, that we actually buy and sell the physical oil, than the physical oil market itself, right? So it's a really interesting market to get into, and it's unbelievably important to everyone's life and economy. And that's what our mission is, right? I'm going on a massive ramble, but this is what I always want to repeat. This is the whole fucking point of why we're here and what Flux is about and what we're trying to do. We're trying to bring more visibility, more transparency to the market, then create a level playing field so everyone can access it, use it, interact with it, so that we can finally get a more democratic market, because it is run by greedy politicians and big oil companies. So that guy's right. He's not mugging us off. He's
right. No, he wasn't. Yeah, I have a car.
I stand by that cock man, whatever he was saying. Anyway, yeah. So let's look at more who's been winning and losing in the market in the last week. This is the gold rush. So let's move. We've been talking quite a long time, so let's just get this done quite quickly. So
yeah, of course. So this week it was a bit tricky to find a gold rush, to be honest. I'm sure people have made money. That makes sense,
because we were saying it's been like de-risking or whatever.
Yeah, definitely. But I think there's been a pretty nice move up in the Brent futures spread. You see, kind of got maybe a bit of a triangle forming here, so we can see if that matches volumes and volatility, maybe a breakout in each direction. But I think people are just kind of taking a break, as you said, and there's maybe a slow trend up in this.
Yeah, trickling up, as in, so this is such a generic thing to say, but if a market is low volatility trending, you expect people to be making money on that. If it's low volume, that's more gappy, and it's like actually kind of people aren't making money. But when there's decent volume, decent trend, but low volatility, which I think we can say is the time spreads in Brent in the Brent market, then that's a good one. I think you're right. I think there's, generally speaking, money being made there. So we just move on?
Yeah, that's not much else to say.
Let's do now the Widowmaker, or the people that have been losing money, the Widowmaker.
Yeah, so you actually touched on this earlier as well, which is a nice introduction to it. So we saw, due to the war, stop-outs in gasoline versus gas oil length in Europe, and we saw really large selling of gasoline based on that. But this just on the screen here is the front gas oil crack in Europe, and you can see there was a huge spike and crash again, and we're still seeing this trend up. It's kind of out of season for this to be trending so high, and for this to be outpacing gasoline, which is more seasonal in the summer, you would think. So like, putting aside the gasoline kind of story, the gas oil strength has been largely coming from the US. We can see the US distillate stocks here so low, really, really low. And there was the war story that was driving narrative, and then that stops and people have gone, all right, fundamentals. As you've said, the war's ended, people are looking at fundamentals again. And this is the fundamentals of the market. The stocks in Europe are better, but not high by any means. But
we also know that US distillates, like heating oil, big export market essentially in the US for distillate. They want to import the gasoline, or generate the gasoline and import it, consume it. but export crude and export distillate. So if the inventories are low, it probably speaks to how much they're exporting as well. Not to say that isn't just independently bullish, but I think that from what we've been saying about renewable infrastructure and the lack of ability to create distillates in what's looking like a strong market, then you have to produce it and export it to Europe. So US should stay decently strong, I guess, on the back of that. But again, remember, this is retrospective. So the problem with looking at inventories and looking at these things we're talking about is they more likely go away to explaining what's happened rather than what's going to happen in some scenarios. So do we think that, we've reached this peak scenario in the summer peak and it could all change because we've had that peak? I don't know. And that's what we've got to go looking for. But.
Yeah. So just a graph to show what you were speaking about earlier, the gasoline gas oil swaps. On the screen, we can see that spike and then that trend returning.
Really surprising. I mean, it came off. A lot of people lost money on this. It's called the Widowmaker contract, and it did have that effect. And then post the stop outs, great. The market generally likes to enter after a stop out, right? It's generally a very strong risk reward thing to do because people stopping out, they've reached their max pain, but it also means that those with the biggest volume who have sustained that pain, it's now over. They've got out of it and they tend to oversell or overbuy depending on what direction they were. So it's a good time to enter because the open interest is thinned out and the kind of, there's a bit of a vacuum post that scenario. So that did happen, right? So we got a rally in that contract back. And then what you're saying is it's now since come all the way back down again.
Which just shows the gas oil strength. We're into negatives in the August EBOB gas oil in metric tons.
Super interesting.
Yeah, really interesting.
Okay. Let's leave that there then. And now let's look forward. This is the crystal ball. Okay, so not a position we want to be in because we don't really have such strong conviction now. But again, I think on average, been definitely more on the bear side on flat price and Brent and even cracks. I think now I have to say it just feels like it's a switch now. It feels like the trend is north on Brent flat price. I think the Brent time spreads, it's harder to be as bullish because they've stayed high this entire time. But I guess net on net, I'd still be bullish. But it looks like just the only thing I would say is not looking too strong is the gasoline market, right?
Yes.
We're meant to be getting peak gasoline prices in Q3. I think we've even been getting some builds in the inventories.
Sorry, also the European physical market has been less sturdy as well. We've seen the E10 barges see a bit of an improvement last week, but I mean support's come from Dangote issues and stuff, but there's just not confidence. There's not bullish confidence.
People made their money, I feel like, in gasoline this year. They were investing early in the year. We had a rally up, they took profit, and we were surprised to see it so early. But it seems like it's a cautious gasoline market that was happy to take money off the table when they did. So that's that, right? I mean, ultimately, that kind of, it's not bearish, but it means that if everything else is rallying, because it's a crack, right? Gasoline versus Brent, if everything is just on a relative value basis, if everything else is rallying, it's going to kind of be under pressure if it's not also got a lot of conviction behind it. Yeah. So I would be bearish the gasoline crack and then kind of bullish everything else is going to be my generic view. Yeah. What do you guys think? Don't agree with me, you're not allowed.
I think I might be bearish gas oil.
Yeah,
I think
it's too high.
Too high. We've seen the kind of RINs news digesters looking at renewable volumes in the US, which kind of we've been waiting for. Just more confusion about the big beautiful bill and stuff, and that's kind of worked its way through now. And I think just levels are so high. Yeah. You might see some better selling. And
this is the problem with trying to predict week on week versus your overall view. I do tend to agree, right? Ultimately, at some point, these things compress to reasonable levels. Is just what goes first. I think what the market's been doing is being super bearish deferred Brent, but the product traders are all bullish. So you've got this completely disjointed market, and that's what we call the crack and the crack rolls, right? The cracks in the prompt versus cracks in the deferred. We call that the crack roll market, and those are so strong, which means at some point something's got to give.
Yeah.
So does Brent rally or do the products come off? And it looks like Brent's got to rally is kind of what we're saying.
Yeah, I think the rally will probably be somewhat capped to the upside because, as we've seen, Trump has, as soon as it gets kind of $75, he gets a bit itchy and he'll come out and say something. Yeah. But then again, you have that really solid floor at like 65. So it just seems like it's a pretty hard capped market at the moment.
And also, I guess we can't forget, if the dollar is going to continue to weaken so significantly, which I think you can say against the euro, against the sterling, it has.
Yeah.
If that continues, then that's really bad news for US consumers, because the dollar's getting lower and the oil prices are getting higher. Their purchasing power, it's like the opposite for consumers outside the US, but for the US themselves, it's not a great situation to be in.
Yeah.
So yeah, interesting. All right, I think we'll leave it there. Thank you very much. And again, really enjoying getting stuck into more of the retail focused stuff, consumer focused stuff. It is our mission to create more transparency and all that. Just a quick reminder that it's not immediate, but we are looking to move more of our media and more of what we're doing towards Flux.live. We want people to interact with our services. There's a big rebranding going on that won't reveal itself for a few months, but we want to start consolidating everything under the Flux brand. So for now, it's Onyx Markets. That's the retail service that you can go and interact with these contracts that we're talking about. Speak to our staff about how you can get involved to protect yourself against energy bills and the rest of it. But also for the industry, we know you're out there, we know you're listening. Please interact with Flux. It's the most liquid platform in the world in oil, financial oil markets. And all our research is on there, all our data's on there, and obviously now all our media. So please go check it out. And again, see you next week.